Good day and a warm welcome to SNS and today's seminar that we are proud to organize in collaboration with the European Investment Bank. My name is Ilinca Benson, and for those of you who I don't know, I'm the CEO here at SNS. I think the strong turnout here today on Friday morning or midday suggests just how relevant and urgent the topic at hand is. European companies, including many here in Sweden, are currently navigating a complex mix of pressures, including intense global competition, high capital cost, regulatory burden, and of course, increasing geopolitical pressures and uncertainties. In this context, the ability to mobilize long-term capital, both public and private, is critical. Institutions like the EIB, as well as private investors and export supporting actors like the Swedish Export Credit Agencies, are all actors in this ecosystem and all important to make this happen, securing long-term capital for our companies. And I'm delighted to be joined by a distinguished panel representing these actors later on. But first, to ground the discussion, we begin with a closer look at the current investment climate in Europe with a special focus on Sweden. So please welcome Emily Sinnott, Head of Policy and Strategy Division in the Economics Department at the European Investment Bank. The floor is yours.
Thank you very much. So thank you very much, Ilinca, and thank you very much for hosting us here today at the SNS. We every year focus on investment in Europe with our investment report. And part of that is actually following what's happening at the firm level in Europe. So we do a very detailed survey of the corporate sector in Europe. So first of all, since we've done this report, we began this report, and what you're going to actually see in the results of the survey is uncertainty was very heightened already for firms. Coming out of COVID, and then the shock of the invasion of Ukraine, the energy price shock. And since then, I think in the last few months, we've experienced turmoil by the day. So this has only just increased. So we're seeing very strong structural shifts in the economy, I mean, most perceptibly in trade, but also huge increases in uncertainty, which affect, of course, the investment and particularly at the firm level are concerning for exporters, I would say. But in general, given the concern as to how this will affect real activity in the economy. At the same time, there's the need to enhance security and spur competitiveness in Europe. So we're focused very much in Europe at this point in time on the structural factors behind long-term growth. We had the Draghi report, the Lesher reports, and now we're seeing some implementation plans emerging, I would say, by the week on these very key topics. So this is really at the fore in Europe at the moment on the discussion. On the policy toolkit, three things that we at the investment bank group really like to stress is the need for further integration, simplification, and to support innovation in the economy. And I'll be focusing on these aspects today in my presentation. We need to leverage on EU strengths, so green leadership in our analysis, and this is really very much grounded in the data. I'm going to share something with you again on this today, is a key opportunity for Europe. But social investment as an enabler in our social model in Europe also needs attention, and this brings to the fore issues like housing, etc. And again, this is a short presentation, but I will point to our work in that direction, and we focused on it in this year's investment report. So firstly, I think it's no big news to you, but policy uncertainty has really increased substantially. So here on the left-hand side, we look at the Economic Policy Uncertainty Index, and we're seeing huge spikes. We're also seeing this with movements in stock markets, exchange rates, some early surveys that are coming out on what's happening with confidence in the US, and to a certain extent Europe, are showing the big impact of the large changes in the stance of the US administration. Out of this, a kind of positive thing is that the EU has been seen as reliable. So I think we're all, as economists, as macroeconomists, very concerned when we see any bad movement in US Treasury bills because it tends to spill over. But actually what we've seen is that European spreads have remained rather subdued given this ongoing turmoil, and it is ongoing. So we maybe thought perhaps the worst is over, and then we're seeing again with the discussions on tax and the budgetary, that this is something that's just going to continue. And as of yet, Europe has been spared from this. And we have a lot of market indications, in fact, that there are portfolio allocation changes in favor of European safer, what are seen as perceived as safer assets. So on investment, so Sweden, like the rest of the EU, really something very stark is that government investment is keeping up overall investment. What we've been seeing is a decline in corporate investment, and also on the household front, we're seeing that it slowed, savings have slowed. So government investment has been very key to keep up overall investment rates. On this, I mean, Sweden's government investment has been relatively stable over time, and it's very strong. So it's a strong feature of the economy, with investment at about 5% of GDP, compared to the European average of 3.5% of GDP. So this is, of course, something important for the economy, but of course we need to tackle this low corporate investment, which can have strong implications for innovation and growth in the future. Now, getting to the integration and simplification and what that means at the firm level. So here, we actually looked to see, oh, sorry, I have gone too far ahead. We had a special focus on this in our report, and we were looking at first of all, the barriers that this created to economic activity, but also the cost just in dealing with this kind of bureaucracy at the firm level. And what we find is that, and I think the IMF have also done some interesting work on this, is that removing a barrier to trade at the firm level can actually increase sector output by over 3 percentage points of GDP. And these barriers, and these, for example, on the single market friction side, relate to things like the regulatory burden for things like health and safety standards, environmental standards, consumer protection. These are all good things, but the problem is that they're often differentiated across our economies. So as an exporter, you may have to deal with 27 different regimes, and it can make it very difficult to comply. When we actually look, we see that this particularly impacts on exporters, but also on SMEs. So what we find is that 1/3 of SMEs in Sweden actually employ more than 10% of their staff to assess and comply with this type of regulation. So reducing these barriers frees up staff for other management planning activities, and is very important. In terms of the barriers to firm investment, what comes out, and I think this is a continued issue across the economies, but particularly for Sweden, is the availability of skilled staff. So almost 80% of companies say this is a barrier. But uncertainty, and this survey was actually done before the change in the US administration, so we're likely to see that this is not going to go away. We have our survey currently in the field for the next round. Going to a bright spot, I think, on the Swedish economy, but something we're focusing very much on the EU level. So we did an analysis within the EU. We followed the firms over 10 years from 2013 onwards, and that reached a valuation of 500 million plus. And we looked at the type of capital financing they were getting, the kind of rounds that they were getting, who were the investors, did they stay in business, what sectors were they in, if they exited, was it for a European IPO, were they acquired by a European company, or did they relocate? And some interesting facts came out of this. I mean, first of all, in the Swedish perspective, of course, the country is doing very well. It's first per capita in terms of VC investment. There's a very healthy capital market here, given that a large proportion of Swedish savings compared to savings in other EU countries are going on equity investors. So there's a very good foundation. Nevertheless, when we look at Sweden, you can see that the overall environment, and this is, of course, maybe something to do with scale, is less advantageous than some of the ecosystems in the US. So here on the left-hand side, we compare these Swedish scale-ups, so these companies that reached the 500 million plus valuation, and with those in other countries, and to San Francisco. So this shows the gap in cumulative capital raised over 10 years. So say the 100% would be San Francisco, and then it gives how much was raised in the other countries. So in the EU in general, about over 10 years, these very similar companies raised about half the amount of capital. They tended to have to get many more rounds of funding, and they got smaller amounts in each of those rounds than those in San Francisco. Sweden is doing better at about 60%, and then the others includes the UK, where the situation, given the market size, I think was slightly more advantageous. This is very important because we know we tend to lose firms in Europe after Series A, B capital. So when we examine when these scale-ups leave, it's at that stage. And here on the right-hand side, we show what happens over the Series A, B, C, D. We compare Sweden with the Bay Area and some other countries. And what you can see is that this is the graduation rate. So you can see the graduation rate is not so bad for Series A or Series B, but it is lower than the Bay Area. And then there continues to be a divide. However, I mean, Sweden also has managed to retain, and here has managed to retain many of its homebred startups. And I think that's something in Sweden that's very advantageous. Again, is that the IPO market is doing very well, and it's the second largest IPO location amongst EU scale-ups. So I think there's a very solid base here, and in Sweden. But building the EU ecosystem is very important for valuation, and also because what we're lacking in the EU is our own big VC funds to invest domestically in our companies. And when we look, we see that many of the lead investors, including in Sweden, come from abroad. While that may not be an issue, there is some association with co-location later on. And given that we do have all of these savings, having and building towards a more pan-European market would just provide more plentiful capital at each of those stages. And we can see over the 10 years how it gets much more difficult for firms to raise money. And one particular area that's very important here is this later stage VC. So here we show on the right-hand side venture capital funds investing in Europe between 2019 and 2023. And in blue you have the general, and in grey you have the later stage. And I think we've seen the later stage increase an awful lot in the last 10 years, but this is really an area that's very important for those scaling up firms. So after the Series A, B capital, when you're taking your idea to the market, it's going to be very important that you can access plentiful and patient capital going forward. And then leveraging on green leadership. So I think this is a positive this is a kind of positive story in the EU at the moment. So I think in Sweden, what we are seeing is when we ask firms, and we have a lot of questions in our survey on climate and what they've done and how they've invested in climate. And we see that Swedish firms have a particularly positive aspect on stricter climate standards, but also on this transition as being an opportunity. They're more likely to invest in every area to reduce GHG emissions. So if we look at energy efficiency, if we look at investing in less polluting, new technologies, in sustainable transport options, Sweden is doing very well. Now, similarly, at the EU level, if we look, and this is Sweden features very strongly here too, we're doing very well in ideas and patents. So what we see here to the left is the number of green tech patents and co-patenting by country or region. So this is the origin of the idea. And here we're doing extremely well. If you see, the EU is at the center of this. At the same time, if we look at the production and the output figures, you can see that China is often ahead in many of these technologies. So one issue is we're having the ideas, but how do we bring that to market? On the right-hand side, there's an indication that we're doing this much better than in the past. even if there's obviously much more opportunity to improve. So what we show on the right-hand side is the green good exports. This is a classification that we agreed with the IMF, and how much they increased between 2017 and 2023 in a cumulative sense. And what you can see is the USA is very small, it's about 22%. Sweden is like close to 70%. As is the European Union. So this is really a bright spark. This is an area where exporters are gaining in terms of their markets. And given the amount of patenting activity, you can really see that for future growth in Europe, this is an area where companies could really have a lot of opportunity to expand. And then finally, I wanted to leave you on the social investment side. So we've had a very big focus on social investment in this report, including on housing. And I'm sure all of you today are very well aware of the issue, particularly I think in the fast-growing economies, which have experienced significant population growth over recent decades. This is a big issue. Here, this is of course a social issue, but we also place this as an economic issue. And I think when I look at the work here on productivity, I think this is also at the fore of the discussion in Sweden. So firstly, there's the participation gap of population groups relative to benchmark countries. There is still in Europe a lot of possibility of activating certain groups, and this will be very important to deal with demographic change and also to sustain our social model. So people with disabilities, for example, here we show the gap to the benchmark countries, so the better performing countries in the EU, stand out as a group that we can better integrate into the labour market. In addition, education of your parents continues to be a dragging effect on your labour market outcomes. Sweden is doing much better in terms of female labour force participation, given, I think, the support of public services than others. But again, this is an area, I think, for continued focus. Again, on younger people not in employment and training. The Swedish numbers come out much better than other countries, but of course, this is something that we need to continue to focus on. So given the limited time today, I can't go into housing in much detail, but I think if you look at all of the housing cost and the increases over time, this is obviously something that's really affected the population. It's a local issue, so we see that you really have to focus here, not at the national level, but on cities. That's really important, and on particular groups. It affects new entrants, younger people, people moving to cities, people having to move houses, particularly where you have a housing system that rewards tenure. So this is just one indicator that shows what's happened to different population. It shows the change in home ownership rates between 2005 and 2023. And you'll see in Sweden, there's a 5% decrease about. For younger people, this is slightly higher. And then actually what's interesting in Sweden is the middle class, so this is the middle income people, have been more squeezed out of home ownership than you've seen in other countries. This is just one indication. I think the rental market, etc., is very important, but we make the case that this is an economic issue because this precludes the mobility of entrepreneurs, young people into the most vibrant ecosystems, which tend to be in the very expensive housing markets that are our capital or second cities. And with that, I think I have used my time. So thank you so much, and it was really a pleasure.
Thank you very much. And please, I would like to open the floor to questions to Emily. So please raise your hand if you have a question and wait for a microphone.
Andreas Widegren from Nordea. You said in, I think, the second part of your presentation that we have a lot of good ideas, but we have difficulty scaling them. Reflecting on that, not only within the green part of your, or the sustainability part of your presentation, but also bringing it to the first part of your presentation, we've gone out and talked to quite a lot of customers concerning exactly sort of where are the frictions, especially in sort of the savings and investment union debate and trying to contribute into the Commission's agenda. And that's basically one of the things that we find. Our customers don't experience lack of capital, they don't experience lack of innovation, but they experience the problem of actually scaling up when they have the capital and innovation, and maybe, as you pointed out in the first part of your presentation, coming to sort of, Series C and D, there's sort of a quite a steep fall in between there. Is that something that you can reflect a bit more on?
Yes, I mean, this is something we looked at. So I think financing is part of it. So we see that just because, after you receive the AB and you go for more capital rounds, it's just difficult to get the depth of financing you may get elsewhere. But it's not only that. So I think we talked about the business environment. So I think it's very important to get that, particularly for these type of highly innovative, high growth companies. They need skilled, very motivated labor. So there you need to be able to attract the labor. This could be anything from housing to tax systems. And on the tax side, I'm not aware what the issues are in Sweden, but I'm sure you will tell me. And then I think the business regulation is also exceedingly important. Building a big ecosystem and clusters is also important. So I think when you talk to these entrepreneurs about why they went maybe to the Bay Area, they're going to tell you, well, it wasn't just about financing. I also had an advisor who wanted me close, who sits with me, introduces me to people, guides my business, helps me on expansion, etc. Sweden is lucky in that sense, in that you have a strong ecosystem. So I'm imagining you have a lot of that advisory support there. And that's more tricky in other EU countries where it's much more nascent. So I think there's a collection of factors. I'm surprised they don't complain more on the financing side, because what we hear a lot is that after you have the Series AB, maybe another round, you don't want to go for the IPO yet, but you need patient capital to continue rolling out your idea and industrializing. And given that you don't have, you have intangible capital, it's very hard to get the loan from the bank. You don't want to dilute with another equity round, so you face this issue, this conundrum of how do you expand at that stage and get finance that at a cost which you feel is worth it for you as an entrepreneur.
Thank you very much. And now thank you so much for the presentation. And given that we are now in Sweden with a Swedish audience and soon a Swedish panel, what question would you like me to ask the panel? What would you bring forward?
So I think for me, what would be interesting, from the EU perspective, is we're talking a lot about innovation, capital markets, etc. Sweden has done a lot of this over time. Are there any quick wins for Europe? Regulation, taxation, etc. What are the lessons that we could draw? Because we're looking for quick wins, I think, at the moment.
Thank you. I will take that.
Thank you.
Thank you very much, Emily.
Thank you.
And now let me welcome Thomas Östros on stage, Vice President of the European Investment Bank. And as you all know, the EIB is the EU's public bank and as such a major provider of long-term financing for projects across Europe, including, of course, in Sweden. And you will share your perspective on the current investment climate and also, I think, on the geopolitical situation that we find ourselves in. Welcome.
Thanks a lot, and so nice to see all of you. I see many old friends and colleagues in the audience, but also some of you that I haven't met before. And thanks, Emily, for an excellent presentation. I hope you will share the slides because there's a richness in the information there that is worth having a second look at. So for those of you that do not know the European Investment Bank, we are the world's largest multilateral development bank. That means that we have a balance sheet that is reaching about 600 billion euros. We lend about, this year, I think we will reach 100 billion euros for the first time in annual lending and guarantees, which is substantial. Still, in the European context, only one player, but without a doubt, a relatively strong player. Our business model is that we have relatively small capital endowment from the 27 shareholders, about roughly 20 billion euros. But with a very strong and well preserved balance sheet, we can go out on the capital market and borrow on very competitive terms. We are treated basically as a sovereign on the capital market with a AAA rating. That gives us a competitive interest rate that we can also pass on to the clients that we have. And we do public financing, we do private financing, we do both large corporates, but also some small entrepreneurial financing. But we also work very closely with many of Europe's financial intermediaries, where we can support them, and they will then in turn support their clients. With the Climate Bank of the European Union, that is probably one of the features that have reached most people when it comes to when you think about EIB. A very early mover in that respect. Since 2019, we do not any longer finance gas, oil, and coal-related energy investments. So we have turned our investment into the sustainable and the renewable field. Geopolitics plays a big role for us because we are the bank of the European Union. The goals of the European Union are the goals of the European Investment Bank. We have a geopolitical situation that is extremely difficult to really assess where we are heading. But the new Commission is profoundly influenced by the movements that we see and that will probably be with us for a very long time. Of course, China and the competitiveness of China in green technologies is one of those areas. You all know the Chinese state-run capitalist successes in certain fields. At the same time, China meets huge challenges with the demographic situation, with their ongoing crisis in the real estate sector, with sluggish growth. But without a doubt, they have, with patience and a lot of capital, gained a very strong position in some of the key green technologies that are highest on the agenda for most countries nowadays. Solar, when I was Minister for Industry and Trade more than 20 years ago, Europe was a leading continent on solar power. Today, almost 100% of solar is Chinese, which means that we have a huge dependence on one of the key technologies going forward. Wind power, Europe has been a leader in wind power with Vestas, of course, the Danish company, one of the leading companies in the world. China is coming extremely strong also in wind with very cost competitive offers and gaining a lot of ground in that. And an issue that we all have on our minds today, EV batteries. In recent years, China is not only dominating cheap electric vehicle batteries, but is in the forefront of technological development in the EV batteries, leaving Europe and others way behind as it looks right now. Sometimes I feel like one of the last globalists. I was a Minister for Trade, advocating strongly free trade, creating a coalition within the European Union of free traders fighting against Southern Europeans, led by, at that time, the Minister for Trade in France, Christine Lagarde. We had many interesting discussions. Very few are of that sort today in the European discussion. The geopolitical development has changed fundamentally the discussion on trade. Of course, one of the fundamental issues here is how China behaves. China supporting an imperialist Russia in a crucial time period for Europe is, of course, a turning point that we all must reflect on. But also the US, the custodian of the free trade system, that has built up and taken care of all these institutions from WTO, IMF, World Bank, multilateral solutions, is now turning the back on that type of system. Or we are back into a system where sort of the pure power of negotiation is the most important thing, not a rules-based global order. Here comes also the Draghi report last year, that has become very influential in the European debate. I hope you all have read it, at least the executive summary, because it's pretty well written and it's a good read to actually go through, showing that since 2020, the gap between Europe and US has widened considerably when it comes to economic development. Productivity gap, tech gap, not least, the US being able to really benefit from the tech revolution, creating companies that 20 years ago didn't exist or was just in their starting phase, where Europe has not been able to catch up with that development. I think that is the backdrop for the Draghi report that also creates the fundamental basis for the new Commission to point out that Europe must be able to try to close the gap to the tech leaders of the world by also developing the European capital market. I think Emily's presentation shows very well, and Draghi report pointed out that Sweden is a bit of an outlier in this respect, creating a capital market that has sustained and pursued Swedish tech companies in a very, very important way. More liquid, more broad, more depth than many other capital markets in Europe. Draghi report shows very clearly that even if this is a very innovative continent with strong universities, strong leadership in green tech, without the depth and the broadness of the capital market that creates that liquidity, it's very hard to get the dynamics in the economy that we need. So we have some certain things to learn also from the Swedish example. And I think the panel debate can go deeper into that. But of course, the fact that you showed on your slides that a substantial part of households and pension savings in Sweden is allocated to the capital market, compared to what we see in, for instance, in Germany, where safe deposit rates, the safe deposits in bank savings is sort of the natural way of a household to save money, is a fundamental reason to that. So to create an integrated European capital market that has the ability to also support the scale-ups of European firms is key. Here our subsidiary, European Investment Fund, works closely with capital market actors, not to take decisions of their own, but to use their capital as a fund of funds, as an asset manager, to invest in European equity funds, venture capital funds, sometimes to take a corner position to stimulate others, pension funds, for instance, to go into that fund, professionally run by the markets, can be a key contributor. For instance, the European Tech Champions Initiative, where 6 of Europe's largest economies, together with the European Investment Bank, put aside 6 billion euros to be able to support larger venture capital funds that can go in with larger tickets for scale-ups in the tech sector, is a way of stimulating that part of the capital market that we do not have compared to the US today. So EIB strategy in this context, a European context where geopolitics is changing fundamentally. We cannot rely on US leadership when it comes to running globalization anymore. We have a state-run capitalist China that is aiming to take some of the key positions in the green technology sectors. Where should the bank navigate and what is our direction? For us, first of all, energy independence. Since the breakout of the war, it has become abundantly clear that being reliant on Russian gas is a disaster for European economic independence. We had that discussion in the Swedish government more than 20 years ago, when the first pipeline from Russia to Germany was discussed. And the Prime Minister at that time, Lars Danielsson, remember well, Göran Persson, was very clear in the discussion we had in our government that in no way we should be reliant on Russian gas, because there was a discussion whether there should be built a connection to that pipeline. A very wise decision. Germany went all in, became highly dependent, gave them a couple of successful years for their industry, but they are there to regret it now. So energy independence is key in this geopolitical situation. We have doubled, and I have the honor to be responsible for our energy lending policy in the bank. We have doubled our investment in energy since the breakout of the war, from 15 billion euros per year to 30 billion euros per year. Renewable energy, sustainable energy, grids to interconnect the European energy markets, and energy efficiency. The next initiative that we are about to launch now is what we call Tech EU initiative. We will allocate 70 billion euros the coming 3 years to the European tech scene, life science, clean tech, green tech, deep tech, and see to that we use all our means that we have in the bank and in the group to support European tech development. Those 70 billion we calculate will mobilize 250 billion all in all of investments. We use our subsidiary, European Investment Fund. I mentioned the European Tech Champion Initiative. We ourselves can use venture debt as a bank, which is an underrated way of financing in Europe compared to the US, where we can go in with high-risk loans to small and medium-sized companies in the tech field to help them to scale up and gain capacity to conquer the markets. We go with corporate loans, of course, to our big European industrial champions, and we are looking for highly innovative projects that we can support, where we also are ready to take more risk. And this is a very clear message from our 27 member states, the shareholders. The European Investment Bank must be ready to take more risk. And take more risk means the possibility of having greater impact, but also, of course, the risk that we will lose in some of the projects. But no doubt, I think that is the direction that the shareholders want us to go. So the bank is a bank with very low non-performing loan ratios, very strong balance sheet. So we are very well placed also to take on more risk to support European tech development. Let me just end with an experience I had at the spring meetings for the International Monetary Fund and the World Bank in April. I've been going to these meetings for a couple of decades. Before I was in the EIB, I was at the board member at the International Monetary Fund. 6 months ago, when we met for the annual meetings in Washington, all multilateral development banks, we are working very closely together, had basically the same message. Climate, gender, inclusion. That was sort of the broad agreement that we had. This year, when we said we will invest in climate, gender, inclusion, it cuts like a knife through the audience. Because other multilateral development banks have America as one of their main shareholders. And since last winter, the rubber is there and they are taking away those words because it's not appreciated by America. At that moment, it's easy to say, I'm very proud to be European. And sometimes also proud that we have these slow-moving processes to take decisions. We can actually stay on course even when times are very turbulent and geopolitical changes are profound. Thank you.
Thank you, Thomas. Please take and thank you. And I think both me and all of you have a lot of questions for Thomas, but let's welcome up the rest of the panel, Anna-Karin Jatko and Pär-Jörgen Pärson. Anna-Karin Jatko is Director General of the Swedish Export Credit Agency, EKN, and the agency offers risk-reducing guarantees to help Swedish companies secure more and larger export deals. And their guarantees are used by everyone from SMEs to large companies such as Ericsson, Volvo, and Sandvik. And with that, you are a really important player in supporting international growth for Swedish businesses. Welcome. And Pär-Jörgen Pärson is a partner at Nothzone, one of Europe's leading venture capital firms. And you have decades of experiences in backing innovative high-growth companies such as Spotify and Klarna, among others. And therefore, you bring a really crucial private investor perspective to this discussion. And I would like to start with you joining the discussion. And let's start with the barriers. Maybe before we continue with the financing. So Emily mentioned the skill shortages, uncertainty, and energy costs as top barriers for firm growth, and also highlighted bureaucracy and single market frictions. Anna-Karin, I would like to hear from you. What's currently holding Swedish firms back when trying to grow internationally?
Let me just give you the sort of SME perspective from this point of view, because as far as Sweden goes, 40% of our exports are based on SMEs. Plus, SMEs are really key sub-suppliers to our larger export companies. SMEs, we know they're important for job creation, they're important for economic growth, but they're also particularly important for innovation. And innovation is key to our survival as Sweden, but also, of course, to the EU. I think one of the many facets of that question is obviously financing. So I'm going to say just one or two words on that. We're meeting with, our goal is to meet with 1,200 of our customers or potential customers this year. And so far we met with 417 of them. And they actually think there are three things holding them back when it comes to this. One is the cash flow. When you're expanding, whether it's in new markets, whether it's with current clients, you need venture capital, you need investment, but you also need cash flow. And cash flow is a question of banks. What do banks feel happy to assume in terms of risks on SMEs, on scale-ups? So cash flow is an issue, and I think that should not be underestimated, because you can't survive only on venture capital. At some point, you must become part of the banking system. International risk, we don't need to expand on that question, because it's every morning when we all wake up, there are new risks, new happenings. And this obviously causes, companies to be hesitant. Is this the right time? It also causes banks to be hesitant. Do we need more risk? What is this risk? We can see that the time period for banks to make decisions when it comes to slightly more innovative companies and their financial needs, much longer. And also, of course, this risk environment means that companies may not be as likely to feel, oh yeah, let's try a new market. There are legal risks, political risks, commercial risks if you venture into a new market, but we need companies to feel, yes, we want to be doing that. Inflexible tools. If you're growing a company, there comes a point where you think maybe my entire house, if you own it yourself or not, should not be mortgaged by the bank or as a security. So I think it's a bit of inflexibility. I've got plenty of examples where you can work around that, but maybe, Ilinca, you want to ensure that we hear from some of our colleagues first.
So Pär-Jörgen, from your vantage point as a venture capital investor, what would you like to add? And also, I think it would be very interesting to hear from you that Emily already brought up, maybe make the comparison to the US scene.
Yeah, I think it's important to create a little context around what venture capital actually is, because many people think it's like a patent solution for anything, but it's not. It's absolutely not. There are many companies that absolutely should not have venture capital, and some companies that are absolutely dependent on it in order to reach their potential. And just like take two examples that you just mentioned, Klarna and Spotify. Both these two companies grew out of Stockholm, became platform companies that are extremely important for the formation of the ecosystem here. They have spawned 150 startups in their turn. However, it has taken both of them almost 20 years to go to profitability, each of them. 20 years during which time they were ridiculed by the European finance ecosystem, because they were building something that was unsustainable, unhealthy, and pretty much something that would not fit into the European financial model, so to speak. However, who were there to finance them? The Americans, of course, because they had history. And if you look at this Magnificent Seven that today collectively represents some 40% of the value of the US stock market almost, they were in a similar situation. Amazon, they were unprofitable for 25 years. Microsoft for 10, on and on and on. So what does that leave us? Well, it is a mindset of building really top level type of companies that have a different set of requirements, that has a much longer time horizon when it comes to business building. And unfortunately, that took a long time before that started to happen in Europe. And we've seen the fruits of that now over the past 5-10 years, I would say. With one exception, that is during the scale-up phase, the later type of financing required, where we still rely heavily on capital from outside of the European Union.
Why is that?
It's because there aren't any funds that are financed locally here in Europe. However, there is also a different reason, is that many of the key scaling requirements that you get to when you have something like 1,500, maybe 2,000 employees, is you'd reach basically the scale and talent ceiling in many of those markets that we belong in. And then there is an additional set of challenges that is associated with that, is that if you start to try to get talent to move to Stockholm, for instance, you have a couple of challenges. One is, what do you pay them? Do you pay them the same as local talent? No, you can't do that because they won't move here. Where do they live? Well, if they need to move into an apartment that they have to buy in order to get here because there isn't any rental market that works, that's another challenge. The third thing is, okay, I want to make sure that I can make a significant upside on this very risky endeavor that I'm doing to work in a startup. So I would like to get some sort of incentive similar to the one I get in the US when I get hired and get options or RSUs or what have you. It's severely restricted throughout Europe. That means that the best talents, they continue to go to the US for that reason until very recently now. And that is, I think, it is the very hopeful message that we have since January, because if Trump is basically shutting down the path for smart people to go to Harvard and then to start their business, and mind you that 45% of all the billion-dollar companies that have been created in the Bay Area has been created by immigrants that went to Stanford and to other top universities. So now we have this amazing opportunity to basically capture and retain the talent, but we have to pay them and we have to make sure that we incent them in order for that to take hold.
Thank you. I would like you to respond to that, but I also want, just so you stay awake and stay tuned, to open the floor to you. If you have any questions, please do raise your hand, and there will be some more opportunities, but don't save your questions for the last 2 minutes like you usually do, because then there will be no time. So please, if you have a question, raise your hand. Yes.
Okay, I think I'll direct this question to Thomas. It's more of a macro question. This investment gap, US versus Europe, isn't that driven by productivity gap? Otherwise, the US couldn't attract the investment. So can we get a better investment balance without curing the productivity problem first?
That's an excellent question. The former head of the productivity delegation in Sweden. But that's right. But the US economy is also a bit of a paradox, because you see these high-tech companies with massive productivity gains, but you also see an economy that lacks fundamental productivity in the services sector. Part of it is, compared to what we are used to in Europe, very strikingly unproductive. So this is a complex question in the meaning that you cannot do one and wait for the other. I think what we should do in Europe is to enhance productivity enhancing reforms, but at the same time do whatever we can to stimulate the capital market on a European scale. Because if we're going to get those more bigger ticket type of funds, we must do it on European scale. I think it's what Pär-Jörgen said is extremely interesting also when it comes to the US. I had a good conversation with the chief economist of the IMF just a couple of weeks ago. He was surprisingly not so concerned about the tariff war. His basic idea was that it will sort of converge to 10% and we can live with that. But he was very concerned about US competitiveness in the knowledge sector and what is happening in the universities. That people are actually afraid. They are advised to go with their visas in their inner pockets when they go to buy groceries. Can you imagine? Also, IMF and World Bank staff is said, have a photo of your visa when you go anywhere, and your kids should also have that. Of course, if that sort of talent magnet that has been part of their productivity success is reduced, I mean, Europe must be ready to take initiatives to be a magnet.
Well, we should see this as an opportunity, even though it's a really serious situation that we are in. But I would like to turn return to what we can do here in Europe in order to raise more capital. And what Emily mentioned, the Draghi report, and every other seminar that we have here at SNS is mentioning the Draghi report. And now the Commission has started some initiatives based on the Draghi report. So I would like to hear your comments on what you think of the Commission's initiatives in order to improve the capital markets and also the investment climate in Europe. Would you like to start, Anna-Karin?
I think it's timely. I think it's necessary. And I think the key challenge is speed. And on the one hand, we've kept peace in Europe by having quite intricate working methods in the EU. And, you know, there are some, Lars Danielsson smiles, there are some advantages to those. At this point, we are looking at a different way of really assessing the competitive landscape. It may be that the US over time will become less competitive. Some of the challenge is really China. You know, I think we're a bit stuck with who is really the competitor and what does it mean. And I think timely propositions by the Commission, but it takes a lot for all of us to be moving faster. And I think one key challenge for Sweden, if I should just mention one, is that when it comes to large Swedish exports, large projects, who finances the buyer of Swedish exports? Not the Swedish banks, not the Nordic banks, the large international banks, American, Spanish, French, etc. We work with all those very, very large international banks. Uncertainty may mean that they may be a little bit less interested in financing difficult projects for buyer of Swedish exports, which means we actually have a bit of a geopolitical issue in Sweden, that we don't have any large banks that are willing to finance the buyer of Swedish exports when it comes to volumes. So I think there are a number of facets to this issue, and this is just an example.
Thank you. Pär-Jörgen, we have the Capital Market Integration Initiative and also this 28th regime of legal framework that's supposed to help startups and innovative firms to get some less legal restrictions. Are these, do you put your hopes in these initiatives?
Well, I think for Sweden, it probably doesn't matter that much. But certainly for Germany, we invest a lot of capital in Germany as well. And just as an example, when you raise a round of financing, you have to go to the notary, sit down with the contract, and has to be read out loud to you. And it can take like 2-3 weeks to even get an appointment. So just doing like the very, very basic stuff in such countries is extremely cumbersome. And it's like it's beyond my imagination that they haven't tried to solve that. But then if you look at the capital markets as such, I think there are a few things that we shouldn't try to fix, because it's probably won't really make a difference. If you pool all the European stock markets together, they're still substantially smaller than the New York Stock Exchange alone. And then you have NASDAQ on top of that, which means that there is a fragmentation that I think is unlikely to be solved anytime soon. So let's not try to fix the public markets. And I think also, although I think we pride ourselves here to have a public market that is alive and kicking, it is not for startups. Absolutely not. That's like the failing companies that go to the Stockholm Stock Exchange. Quite frankly, yeah. So I would not sort of put my hopes on that. I would, on the other hand, try to make sure that we have like a full chain from the early stage, which now has actually functions pretty well all across Europe, to the later stage and to the growth stage type of financing, and the bank financing, the venture debt opportunities and such. If we can get that to hum a little bit more, I think the public market issue would probably sort itself out anyway.
Would you like to respond and maybe add some?
Yes, on the simplification agenda, I think it's great that the new Commission has that as a top priority. But I think we also could be a bit self-critical within the European Union. Some of these simplification measures comes from very complicated legislation that was taken decision about just a few years ago by the European Union itself. So, I mean, we need a change of mindset to have more of clear legislation that is not so detail-oriented that we have a tradition in the European Union of pursuing. And that now maybe that is the chance to do it, but that we need a lot of pressure to get that done.
And where will this pressure come from?
From industry, for sure, from private side, absolutely, but also from public side in the political sphere. I think we should push and push and push to try to get a much more usable. Think about the Sustainability Reporting Act that was taken decision a few years ago. That, of course, when it hit private industry, it is a very complicated matter to deal with. We should not put that type of legislation into place in the first place.
I think we're actually already running out of time, but there will be time afterwards to stay for a wrap and to also to talk more. But I would like to end on a positive note. So I would like to hear from Anna-Karin and Pär-Jörgen. Emily mentioned green tech as one of the important industries for Europe to take leadership on, and you are the climate bank of Europe. But what other, or this sector and what other sectors should we sort of put our bets on from your perspective? Anna-Karin and then Pär-Jörgen.
I think you know full well there are a large number of very innovative Swedish companies. There are fantastic examples of all kinds of, technical developments in all kinds of areas. So I think we need to make sure we don't lose sight of the fact that, yes, we have the ability to innovate, and we need to make sure, obviously, these companies can scale. From our point of view, we see an unprecedented demand. Obviously, energy, that's an area where Sweden has a lot of technology. It's a cold, grim climate. We know about energy saving and efficiency. That demand is magnificent. Defense goes without saying. Very, very large-scale defense deals we're looking at the moment. And last but not least, telecom. There are only 2 telecom companies in Europe. One is Finnish, one is Swedish. That area, 5G. There's a lot of 5G left to expand on a global scale. So I think we have a number of sectors in Sweden with their sub-suppliers where we really have a classic comparative advantage. So we need to feel a bit optimistic around the fact that we're innovative and we're in the right sectors for Sweden to grow their economy.
Pär-Jörgen.
Yeah, I would agree that the energy transition is also a very big theme. And John, Flowers Technology CEO, is sitting here in the audience. It's a portfolio company of ours, and I'm a proud board member. So, yeah, I plugged you now, okay? But also very importantly is the ongoing fundamental technology shift of powered by AI. And that is, during the 30 years that I've been in the venture capital industry, that's the biggest shift I ever seen. If you liken what's going on in the tech industry as a big box of Legos, you can say that the Lego pieces were invented in the Bay Area, but now the companies across Europe and more importantly here in Stockholm are putting those Lego pieces together in really, really smart ways. And we have some of the most innovative companies in the world in Stockholm, growing from 0 to 50 million euros of revenue run rate in less than 3 months. It's like never seen before. And this is something that I think will have a dramatic impact on every workplace, every work process, every care process, or what have you. And I'm extremely bullish about it, but also pretty wary about what the societal effects might hold in stock for this change that is happening.
Thank you. I think that's a really good note to finish on. So energy, telecom, AI applications, and of course green tech are the sectors that we should really look out for and try to help maybe and boost. So thank you a lot for this discussion. Thank you, Emily. Thank you, Thomas Östros, Pär-Jörgen Pärson, and Anna-Karin Jatko, and all of you. And I hope that you will continue the conversation. And I would also like to just tell you that on June 3rd, we have a related seminar on how to put maybe pension fund money at work in the investment sphere of startups or other alternative investments. So I hope to see you then again. Give our panel and Emily a warm applause.